Good evening and welcome to tonight's Yukon City Council, Yukon Municipal Authority work session. It is April 18th, 2023 at 6:30 p.m. We're in the council chambers, the Centennial Building, which is at 12 South 5th Street in the great city of Yukon, Oklahoma. Tonight, we'll be discussing the performance meter presentation by Frank Crawford of Crawford and Associates, PC. You want to come forward?
So I guess let me preface this with, you probably have a couple of electronic documents or maybe printed documents in front of you. One is the City of Yukon's audit as of the end of June 30, 2022. It is 82 pages long. If you've ever tried to read it, it's not the easiest read in the world. The numbers are extremely small and there's a whole lot of them. Usually a big turnoff for most non-accountants. Tonight, I think later on at your normal meeting, the auditor will show up and do a little summary of their reports of this, but it's pretty simple. They issued what's called a clean opinion, meaning that they've done enough test work on all of the numbers in there that they feel that those numbers are free of material misstatement. So in other words, they're real, which then allows us to kind of analyze what those numbers mean, which is the second report, which is the one we'll probably discuss in the workshop. So the performeter, also called the perfometer and mispronounced all the time, doesn't really matter. It's a made-up word. About 23 years ago, there was no very good way to analyze basically the health and performance of a government, and so we tried to invent something that would do that, and we got to invent a word that's got copyrighted and trademarked, and that's what you see in front of you. It's a very simple concept, and I know many of you have been through this before, so I won't belabor you. But it takes the 82 pages and basically reduces it down to a single question on a scale of 1 to 10, or technically 0 to 10. How are we doing? A 10 representing excellent financial health and success and sustainability, and a 0 representing very poor health and performance and sustainability. And so pretty much you gauge a number of different financial statement ratios that we look at, and we score them and benchmark them every year, and we produce a score, and then we kind of keep track of that every year so that you can kind of see how the city is doing. So the first couple of pages just are more of the introduction, and I just noticed that the page numbers are in the bottom right corner in the very blue, but the page numbers are gray, so you can't really see them very good. So I'm going to flip you to page 5, but it's the performeter rating. It's the overall slide. And this is designed pretty simple. There's 3 ways to read this. You can, if you like pictures and tables and graphs, there's usually a graph or a table on the left that kind of shows you maybe up to a 10-year history of what's going on. On the right side, you see words, a very simple description of what that slide represents. And then if you don't like either one of those, usually at the bottom on the right corner, you'll notice a number that's either green, yellow, or red. Green means good, yellow's okay, red's probably not so good. So let's go to our score. As you can kind of see in the charts and graphs, we've been kind of on a tear the last several years as far as our financial health and success, from a very low point in 2014, 2015, now all the way up to an 8.1. To give you a little bit of perspective of where an 8.1 falls on the scale, there isn't a government that exists that can score a 10. It's just impossible to ace every ratio. That government doesn't exist, because if it did, we would all go move there and live there. You know, low taxes, new infrastructure, low utility rates, no debt. That government's not there. The highest score in the history of this performeter for 23 years is a 9.1. It's only been scored twice by a couple of different governments, one here in Oklahoma, one in Georgia, and it's only happened once for each government. So the fact that we're in the 8s is extremely high. That's very, very good. Anytime you land in the 8s, it's an impressive score. The overall score, though, can actually be broken down into little components. Since I look at about 16 or 17 different financial ratios, some of them deal with health, like what we call the financial position of the government. What do we look like as of June 30 of 2022? What's our health score? We also look at the performance of just that 12-month period. So for the fiscal year that started July 1 of 21 and ended on June 30 of 2022. And then the third component we look at is what we call capability, but really means sustainability. Do we control enough of our revenue streams? Have we maxed out on our debt obligations, or we can't issue any more? Have we maxed out our sales tax rate to where we can't, raise our sales tax rate? And so those three components are what basically come together to produce the overall score. So we'll take each one individually, and then I'll maybe point you to a couple of different slides that I think are important for the year, and then let you ask questions if we need to. So what's the health part? The health part of this is the 7.1, the financial position score that you see on slide 5. So health, we're scoring above a 5. 5 is what I consider to be satisfactory. As you'll notice on the summary table that I'll point you to in a little bit, our financial position has been getting better every year from the lowest points of where it was in, say, 2014, 2015. The reason the health is getting better is because of the second number, the performance. We did ace all 5 of the performance ratios this year, so we literally scored a 10 for the fiscal year performance, so it's hard to beat that. And then as far as capability, that score doesn't really change very much from year to year unless you really aggressively go issue debt, or you raise your sales tax rate, or taxes become a much bigger component of the revenue budget. And so that's score we look to see just above a 5. And as long as it stays above a 5, that means you have some sustainability. So we're at a 6.3, and that's where we end up. So if you added those 3 numbers up and totaled them and then tried to divide by 3, it's not going to equal exactly 8.1, because some ratios are more important than others, and so we weight them. Some have a heavy weight, some have a lighter weight, and some kind of have a little bit of a moderate weight. The important thing is that, just as the graph shows on the left, we've stair-stepped ourselves up to a point where we're now in performing very well. We have excellent financial health and success. And again, we had dropped all the way below a 5, not but 6-7 years ago. So for those of you that were around at that point, I'm just not telling you anything that you didn't know. It was apparent of our financial condition and what was going on at that time, but we have literally dug ourselves out of that position and nearly doubled the score. So that's excellent. So the next slides that follow, and again, I'm not going to go through this whole thing, are basically each individual ratio that we look at, and you can kind of see the score of that ratio at the bottom right, and then a table on the left, and then a history at the bottom of how that graph looks. And so I'm going to pick a couple of these and kind of explain them away a little bit, and I'll start with the one on, if I can even read the page number here, maybe slide 8. It's called level of unrestricted net position, and the score doesn't look very good. It's a 0.6 on our scale of 1 to 10. In other words, what amount of our net worth do we have in an unrestricted capacity, like a kind of a rainy day component? And one of the reasons why this doesn't score very well is not really anything to do with you. It's because of the state pension systems, specifically the firefighter pension. It's woefully underfunded, but instead of the state recognizing that liability, they pass that liability proportionately down to every city who has firefighters. And so based on the number of firefighters you have, you absorb a pretty significant size of a liability that kind of makes this a little bit artificially lower than what it actually is. You won't ever pay that liability. It's not like you have to write a check to the state. But what you will do over time is you'll contribute a required percentage that they tell you to contribute, and they'll invest that money. And then in theory, that firefighter pension system will fund itself over a long period of time. But for now, basically, it's kind of weighing down on your overall net position. Something that may look a little bit better is on the next page, which is kind of the general fund component. The general fund is pretty much the city's operating fund. This is where most of the city revenue goes in that's not utility related, and most of the city's operating expenses that are not utility related flow in and out of. At the end of the day, there needs to be something left over. It's called fund balance. You might call it cash reserves or rainy day funds. But what we do is we try to measure it as a percentage of your annual revenue stream. And as you can kind of see again in the picture, we had literally depleted all of our reserve fund balances back in 14, 15, and we're actually negative. We had dug a hole, which is a terrible place to be. And then slowly, over the next several years, as revenues increased and expenditures got decreased, we kind of dug ourselves out of the hole, and now we have what we call a 41% unassigned fund balance cushion. In other words, we could literally go almost half the year and not collect any money at all in the general fund and still pay all of the expenses for operating the general fund. That's a extremely comfortable cushion to have, and it scores a 10 now, so you can kind of see the history of that ratio. In addition, there's another 6.8 million that the city has in what we call a stabilization reserve that was also depleted back in 14 and 15. It was gone too. It's now been fully funded and actually has a little bit of excess money in it. It's now 6.8 million in addition to the 40%, the 41% that we see here in the general fund unassigned. So basically what that means is we've got a lot of cash that we're sitting on right now. And again, there's a reason that we sit on that cash. It's because we want to do something big at some point in time in the future, and that cash would allow us to do it without having to borrow money at really high interest rates in today's market. So excellent cushion, fully funded reserves. If I included those reserves into this calculation, instead of 41%, it'd be 66%. So that's a pretty significant component. Couple of other things I'll point to on slide 13, I believe, where we're talking about the non-uniformed employee pension plan. I'm sorry, go ahead.
Ms. Kretschmeyer had a question.
Sure. Please interrupt any time for questions. I don't have to be a talking head up here, so.
Back on page 9, on our unassigned fund balance, will you tell me in that account how much you would prefer that we kept in that account? Because I've got unions telling me that.
Yeah, I understand. It's kind of one of those things where depending on what happens in the future, it might not be enough even at 41%. If we were to have a one-time disaster or an emergency or something that we hadn't planned to do and we have to do it, that's kind of what that is there for. And so the model pretty much says, if you want to score a 10 for the model's purposes, you wouldn't want to let it drop below 30% of your annual revenue stream. But 10% is the minimum that I would say is acceptable or average. So if you scored 10% of your annual revenue stream in a reserve or unassigned capacity, that'd score you about a 5. So you're 41%, so you say 11% over the max score. So you could deplete some of this cash and still score a 10 on this ratio. The problem is if you deplete it on operational things, it's not a 1-year expense, it's every year expense. So you might deplete 5% of it next year, but if you've obligated 5% a year from now on and you don't have any growth, that 41% is going to go away very quickly. And that's kind of what you have to guard against. But luckily, over the last several years, we haven't had that issue, and we've been very fortunate. COVID actually did you a favor from a financial standpoint. I know it sounds crazy, but COVID forced everybody to buy local, either online, which generates a use tax or a sales tax for you, or shop locally because they couldn't go anywhere or didn't go anywhere. So now that there's a comfort level with shopping online, I think we're going to see some of the sales tax returns lower themselves a little bit, but I think the comfortability of buying things online is going to stay there and still produce a lot of revenue for us. So, but you've been having double-digit growth in your sales tax for the last 2 years nearly. I mean, if you looked at 2 years worth of sales tax returns, 21 and 22, it's 20% higher than it was in fiscal 20. 12% in 1 year and 7 or 8% in the next year. So it's really hard to sustain double-digit growth in sales tax. I mean, if it wasn't, and you raised it 10% every year, in 10 years, you double your sales tax? That just sounds really outrageous right now, unless you change the rate. So sales tax is probably gonna calm down a little bit, but it's not gonna calm down to pre-COVID levels. I think we're kind of
We're starting to see.
I think we're in a
that.
new normal.
We're starting to
maybe.
see our sales tax though decrease.
Yeah, I think it's gonna come down. I just don't think it's gonna go back to where it was. I think there's a little bit more comfortability now with
Part of that is
online
due
shopping.
to Oklahoma City building all around us, so shop
And true.
local.
And the more economic development you
Yes.
have, the more people you bring into town, the more they spend, the more
Right.
money the city gets. I mean, that's kind of the way it all works.
Thank you.
You bet. On slide 13, let me talk very quickly about the non-uniformed employee pension system, which covers everybody that's not police and fire, that's in the state plan. I'm only gonna talk about this because seems like it's been a point of contention for a lot
Page
of times.
11 or 13?
I think I wanna say I can't really see it very well, so that just tells you
Say
probably.
non-uniformed employee.
Yes.
That's 11.
All right, let's go to 11 then. 11 that you can't really see the page number. I'm gonna change those into white numbers next year, I promise.
And the other.
I probably said that last year too, didn't I? Oh my. So, on the non-uniformed employee pension system, notice the percentages have kind of been hanging in the 80s, for a long time. And although that's fine, and a pension system can pretty much support itself with an 80% funded ratio, as long as the size of the employment of the government doesn't contract. In other words, you go from 200 employees to 100, you can sustain a pension system just by current contributions. This year, though, it's a little bit weird. It's June 30, 2022 for the city, but the plan's fiscal year is actually in 2021, and that's what shows up here. At the end of 2021's plan year, the investment and the markets were at an all-time high. This was before everything started tanking in December of 21 or January of 22. And so the city's Oklahoma Municipal Retirement System that's ran by the OKMRF group had an investment return for that year that was outrageously high, which literally jumped you from 81% to 96% funded. So nearly fully funded your pension system in 1 year. That's gonna go back down because the market isn't where it was in December of 2021. And so when we see next year's 2023 results, what we're gonna see is the plan's 2022 year, which isn't gonna do us any favors. So this is gonna kind of drop back down. I don't think it's gonna go below where it was, but it's kind of an anomaly this year and kind of improved our score a little bit because, the closer you get to fully funding your pension system, the higher the score ends up going. But that's the highest I've seen it in a decade, from what I can remember. But again, I think it's gonna kind of come back down a little bit. Last couple of slides, let's see if that was 11, that's 12, this may be easier to do it this way, that's 13. Let's look at slide 14, which is called current ratio, and slide 15, which is called the quick ratio. Those are fancy words for cash flow. On the current ratio, what we try to see is that the city tries to maintain $2 of current assets for every $1 of current liabilities, and that would be average, that would be a 5. So instead, we have $5.34 to every dollar. In other words, for every dollar in checks we have to write next month, we've got $5.34 in current assets that either exist in cash or can turn into cash very quickly. That scores you a 10. That's a pretty high ratio. It's probably as high as it's been in a while. And then on the current ratios, the same thing, except it ignores receivables and investments and just looks at liquid cash. Do I have at least $1 of cash that I can write a check for $1, a 1-to-1 ratio? We're scoring $2.84 to $1. So again, excellent cash flows. But I want to caution everybody on this one too. I know I'm kind of throwing a lot of warnings here. There's a lot of one-time cash here that isn't going to come back. The CARES money, the ARPA money,
Right.
that stuff happens once in a generation typically, and it's happened. So it's going to be a while before the federal government doles out money of that size again. So we got a lot of money. We got quite a bit. We got millions, literally, in almost a gift from the federal government. And that's why you've debated what to do with that gift over several meetings to figure out, do we want to spend it on infrastructure? Do we want to spend it on this? So obviously, I think you've put it in your public works side, so you're gonna invest it in infrastructure, or something along that line, because that's where the money is sitting in cash, at least at June 30. And then, of course, you have another tranche of ARPA money that came in after June 30 in August or September. So that's gonna run out at some point in time, but even though it's there in cash right now and it inflates these numbers, again, we can spend some of this cash and still score tens. And depending on what we spend it on, will improve other ratios. If we buy infrastructure and capital and equipment and things of that nature, it's gonna improve these scores, because really we're trading $1 of cash for another asset that's equal to $1, and we're not really doing anything. We may be spending the cash, but we're investing it in government assets. So that's kind of the end of those slides, and if you flip the very next slide, which is 15, I believe, or 16, it's the summary slide that basically says, okay, here's the last 5 years of all of those ratios that we just looked at. And again, down at the bottom, you can kind of see this is the health score of the city over the last 5 years. And again, in fiscal 22, the health is at the highest score that it's been. And the lowest score shown on this chart back in 18 was a 4.2. So you can kind of see that we've improved the health, but we've improved it by performing so well over the last several years. So with that, I'll go to a couple of performance slides, and probably need to speed up, don't I? I don't have all night for this. You don't have all night for this. Let's look at slide. Somebody's gonna have to help me here. I'm looking at sales tax growth, and I think it's on slide 23, maybe? Need to get my better glasses out. Good, thank you. Remember how I talked about sales tax and how it's kind of been going up? Pre-COVID, let's look at the flat line in the 2 or 3 years before COVID. Wasn't really doing a whole lot. See that flat line in the middle there in 18, 19, 20. And then all of a sudden, we jump 7.4% in 21 and 12.4% in 2022. I mean, that's really impressive. I mean, it's hard to replicate that. It's hard to sustain that over a long period of time. But again, I think it'll come back down. But you know, if you get 3 to 5% growth a year, that's a 10 in this chart. So you know, 7 and 12 is. I wish I could score it better than a 10, but there isn't anything above a 10. And so I kind of quantified what that means. You know, if you basically collected an additional almost 3.4 million in sales and use tax this year, that means that the retail sales had to be around 84 million additional just in 1 year. So that's really impressive. Again, probably not sustainable, but I'll take it, and I think you should take it too. The next slide kind of shows the summary of those performance ratings over the last 5 years. Basically, the way to notice this is look at the bottom row, and notice that we've been in the 9s for almost all that time. So our health is getting better because we're performing so well. I mean, it just goes kind of hand in hand. The last set of slides, I'll probably just skip maybe to the very last slide and show you the summary, or the next to the last slide, of the sustainability or capability ratings. I'm probably on slide, somebody help me, 33? I'll take it. Notice that the bottom line here, those numbers don't change very much. They're 6.2, 6.3-ish, kind of floating up and down. Again, the only time this changes pretty dramatically is when we issue a lot of debt, which we kind of did in 2018. Notice that, you know, we had a lot of bonded debt per capita. Now we've paid the debt service down. If you looked at the debt ratio a few slides back, you would have seen how we've been paying off the debt systematically and over time. So again, all we need to do is stay above a 5 on sustainability. And so the sum of all that stuff kind of gets you back to that slide 5, you know, where we're scoring that 8.1, and that's kind of, as I said, that's a good score. I probably had maybe 3 or 4 Oklahoma governments get in the 8s this year, which was kind of odd. Usually I have 1, but your trend has actually been replicated by cities all over the state. COVID was good to most of these communities, and only about probably 5 or 6 really larger communities were the ones where they kind of got siphoned off a little bit and everybody stayed local. So it was really good for you and cities like you. So now if we can just stay in the 8s, that's our key. But I'll live in the 7s. I can assure you the 7s are very good also. So with that, I don't know if you had anybody else planning to speak during this workshop, but if you did, I'm sorry, because I just ate up all your
okay.
time. So, and I assume you want me to do this again, only shorter and much faster in the open meeting? Okay,
Yes.
I'll be happy to do that. Any questions?
I think it sounds wonderful. Thank you, and thank you for being so detailed in this one.
You bet.
folks.
I appreciate the chance to visit with you. Thank you.
All right. All right, we will take a break and come back at 7 o'clock.